about Roaring Kitty.
Yeah, unbelievable. I can't believe we come back to this.
I mean, this is close. I love this story because this is what it's linked to the way we think about markets, right? Financialization and the power of positioning. And that's why this market, this rally. Hi everyone, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive, Onyx Capital Group, joined today by the usual Martha, Vincent and James. Just a quick reminder, James now runs a weekly podcast, Macro Mondays, that goes through trends, risk analysis, equities, bonds, and everything really outside of oil. So if you're interested in that, please check it out. Whereas the oil markets, we remain in oil market purgatory as consensus still believes in a summer spike, while the bears seems to have done the damage is done and now they're leaving type situation. So what next? Well, if in doubt, dive deeper into the minutiae and search for the truth. And that's exactly what we aim to do here on this podcast. So without further ado, Vincent, do you want to start us off?
Of course. So in the past week, Brent crude has consolidated around the $82, $83 per barrel region after the previous sell-off, which saw a massive liquidation of managed money length. And in fact, the largest since early October last year, which our viewers may recall that's when Brent sold off by $10 a day and came off well and truly from the $90 handles, saying goodbye to the possibility of triple-digit oil. But over the past week, it's not as many headlines, but the bigger one was over the weekend where Iraq's oil minister, Hayyan Abdul, initially said on Saturday that Iraq would not agree to renew cuts, but suddenly on Sunday did a 180 mentioning that Iraq will actually continue to cooperate with other OPEC member states about this voluntary cut. Indeed, a Bloomberg survey showed that 7% of respondents expect cuts to be extended. And another headline that helped support crude sentiment was China's issuance of ultra-long special sovereign bonds this week aimed at boosting stimulus. So initial plan was announced in March, but this week more concise details were revealed. Finance Ministry was saying it was starting to sell its first batch of its 1 trillion renminbi, $140 billion USD equivalent of special bonds, quite a bit to be used in infrastructure investment, which includes housing. So it's the first 40 billion yuan of 30-year bonds will be issued by this Friday. So this is the fourth batch of such a large stimulus package in 26 years. The last time was during COVID in 2020. Some analysts say that the boost to GDP could be as much as 1%, but its timing could also be intended to offset the impact of US protectionist tariffs that were also announced recently.
Yeah, I mean, we could dive straight into that because that is a pretty big deal, right? We've repeated a lot of times China's kind of oversold nature and now coming strong back. But James, I mean, straight away on that, like that's issuing so many bonds, given how nefarious, I guess, the situation you could argue with the US bond situation. They're borrowing from China, keep borrowing from China to fund their own situation. And now China are looking for their borrowed money back, or like investors' money back, his dollar-denominated debt back. And then is there not the issue of, I guess my question initially is like, people I thought were really scared of investing in China now. And one, because it probably lost a lot of money in the last couple of 3 or 4 years. But also, they could have maybe made further strides to be the new reserve currency had they been more open to, that's just a topic for debate. But you know, that natural transition we tend to get from currencies could have happened with China maybe if they were more open to this kind of investment. So do you think there's a likelihood that they're trying to make that move now to be the world's reserve currency? Or
I think they already started a couple of years ago. They started to develop a central bank digital currency. They've been testing that for at least 2 years now. So that's an attempt definitely to become a stronger reserve currency. I think here it just smacks more of more stimulus, another attempt to stimulate the economy.
But someone's going to have to fund it.
There's more cash on the sidelines in China at the moment. People are reluctant to invest in property.
Oh, so it's just a domestic thing.
I think it'll be much more domestic.
Wealth. Okay.
Yeah. Well, we've seen money move into gold as well, but you'll see domestic buying.
Okay.
People are scared of property.
Okay. And I guess, before we go into that, I mean, there was the, just to finish that off for what you were saying, Vincent, so big macro, kind of very different thing to what we usually talk about. But at the same time, OPEC's coming up, right? And that's you talked about the Iraq insinuating that cuts are going to be extended. So if we don't get a cut, and no one believes there won't be a cut, but if they do cannot continue the cut and oil supply comes back online, I guess we've got to make the assumption that the oil market's in trouble. That's just got to say that, right? But that aside, how are the EIA stats?
Yeah, the EIA stats last week indicated a draw in crude, 1.3 million barrels week on week, but there was a corresponding build in Cushing, 1.8 million barrels, as well as in gasoline and distillates as well. So overall, a build in the refined products, but it wasn't necessarily so bullish or bearish compared to previous weeks, which caused stronger price action. But it's the build in products just shows the perhaps the slight weakness in demand ahead of the summer driving season, as well as, and actually in distillates, for example, there's been slightly more builds, less product supplied for the fossil fuel distillates, because that's been kind of replaced by some more renewable diesel as well. Biofuels, which has also dampened the sentiment in actual diesel distillate fuel oil.
Yeah, I mean, ethanol, from what I last checked, has been quite weak. So I don't know if that's been helping things, more delivered products being available. But either way, yeah, we're getting pretty serious dips in products. We've been talking about this for a while, a washouts before expiry, before summer, but it does just seem to be continuing. However, we mentioned the EIA stats, the US stats, they're always really important. But the refinery utilization being up 1% doesn't sound like a huge number, but it is, right? That's quite a big difference, and it's transpired into, people utilizing crude, having a draw, and then build of products. It's kind of sensical. But I think what the significance of that is that, again, if you're bullish product cracks, in particular products minus crude going into summer, a lot of that was based on a repeat of the last few years' refinery outages. And we keep saying this, but it is relevant. I mean, if you're going to rely on supply and demand balances, there's so many variables that can shift, this slight number at the end of net supply versus demand. And if a lot of that is based on, overheating, refinery fires, things like that, and it's not happening, and if anything, refinery utilization's up, then, that's kind of spells trouble for bullish positions. I think for me, the question is, a lot of downward movement in product cracks. Is it long stopping out? Is it new shorts? Of course, this is the first question you ask. But I think if you go off consensus, you look at the consensus supply and demand balances. I was even getting questions this morning from traders outside of Onyx asking my opinion on it. And, they're saying everyone's still bullish on the supply and demand basis for summer. That doesn't change. Okay, so how does your positioning change? Well, from the data we've got, swaps, it looks like Q3 is still being bought into, the lighter ends in particular. But I'm assuming diesel is quite well supported. Fuel oil has been quite heavy, but across the board, people are hoping still for this summer spike. And it was last year the same thing. It didn't quite happen, and then in late June it started to take off again. And if we define summer as Q3, July, August, and Sep contracts, we're probably still a month away from that really needing to happen before it doesn't happen. But Martha, just in terms of the moves, it's particularly in the exchange traded futures, so Brent, WTI, RBOB, these are the headline futures, and them getting decimated. I guess there's an element of momentum from CTAs, right?
Yeah, of course. So we've looked a bit into this at Onyx with our proprietary CTA positioning model, and you can see that this massive removal of positioning by the CTAs has really exacerbated the price action over the past week. We'll probably get it up on screen now. So you can see this is an overlay of the CFTC managed by money positions on top of the Onyx CTA model. And you can see that absolutely huge drop, really, really steep in the past, most recent data. So I think this had, looking at...
Sorry, this is for all products?
Yeah, this is for all products. Combined positioning for all products and
Right.
the overall CTA model.
Yeah, it's a substantial decrease.
Yeah.
So I guess it's the thing with CTAs. So they have to, for them to be considered short, they have to be short, right? As in, so it was all just liquidation. So that shows you, if anything, how strong the momentum was, I guess, it was growing momentum and then suddenly shifted. So they've probably got a way to go on the downside. You could argue if the downward momentum's still there, if the signals are still there, but we have leveled off, so maybe not. And this is the whole point about reconstructing these guys' models, right? Because they're just going off relatively straightforward momentum-based signals, moving averages and all that. So
what if the risk here comes from the CTAs actually going short?
Yeah,
especially if the market's already long. And something I'm seeing in the macro space is last week was a fairly quiet week, little data, not much volatility. The data we did have, though, jobless claims suddenly spiked higher. There's more weakness in the employment. And then University of Michigan consumer confidence, which representative of the whole country, that plummeted. So consumers' current expectations and future expectations literally plummeted from high 70s expectations to mid 60s. But with that, also their inflation expectations have ramped up. We've seen it with the UK employment this week, today. Very weak employment data, but again, inflationary average earnings coming in. So what I'm getting at here is we're starting to see the economies are slowing. UK's just out of recession, but the US, it's been steady. GDP Q1 came in way below expectations. Now unemployment's ticking up. And what could save the economy would be a more stimulative central bank, but the Fed can't cut rates because of inflation. So they're stuck, and it's starting to strangle the economy. So a chart we highlighted was the 10-year yield. And you can see there's a key sort of trend line support coming up. But what it's done, it's fallen since the Fed meeting. You've had weak employment data, weak secondary data last week, and now just above 470, the 10-year yield's basing there. But we have CPI on Wednesday, and that becomes crucial because all the inflation data for last month has been above expectations. So economists have raised their expectations for Wednesday, but what if it misses? Then we have basically the market will start to look at recession, the risk of recession, unemployment's going up, the 10-year yield will fall, and this is taking it all the way back to Brent.
Just get on that trend immediately, and it starts being a self-fulfilling thing.
And taking it back to Brent, if we're moving towards recession, demand falls. The largest economy in the world, was it just over a quarter of global GDP?
Yeah, no, it's undeniable. It's funny. That's why I guess I call it purgatory, because it's just you can see the downside, but it would just be such a big deal because of the OPEC situation, I guess. But then on the flip side, you can also see a spike because of how we usually get this spike in summer and people expecting it. And generally speaking, it's done the same thing the last few years, but it really could go either way. I guess it's just harder to believe in it because it's not really adding up to I guess the patterns of the last few years and the current fundamental situation. But it doesn't matter, right? And I guess what happens is usually the least expected thing. So I think the CTA point is pretty good point actually, and I hadn't really realized it's just flattening, but it's got a way to go, especially from the macro side. So it could all be linked again. And we were quite or you were quite clear last week. The correlation with interest rates and Brent has been very strong.
Absolutely, for the last 18 months. So if the market's looking at either recession, then demand for energy falls. Or growth.
So it's just OPEC versus interest rates versus macro sentiment, and that flow of money is just clearly it's been overpowering oil for quite some time, but particularly in the last few months, I would say that's been overpowering, and so you really need unfortunately, you need like a war type scenario, geopolitical tension type scenario, which drags the financial money back to being bullish, because that is such a binary event that they can buy into. They're not really going to buy into, the S&D looks strong and EBOB crack positioning. Then they're just not going to look at that stuff. They're going to look at macro things. And the only thing that can fight a weak macro sentiment market is a geopolitical situation.
But if oil price keeps going down, there's a point when the speculators throw in the towel.
Right.
So where the stop loss is, and then all of a sudden you get a faster move to the downside.
Which we've seen. So are we saying that the managed money thing, you've got to split it up. The managed money has CTAs, risk parity, discretionary. So we're saying that the liquidation in Brent is almost certainly mostly CTA positioning. So there's still the discretionary money long, which is probably in the risk parity long, which is more related to the macro scenario. And if they liquidate, in this scenario. Ironically, they would then be the trigger to drive things lower, and then the CTAs will get short. So it's vulnerable.
And that's typically when you get the quicker move as well, when the speculative money liquidates.
Yeah, it'd be so unexpected, but I guess that's
when it happens.
That's trading, yeah. And so what else happening on macro? Was that kind of the summary, or you think?
That's it. Fairly quiet. Last week was quiet. This week's all about CPI on Wednesday.
Yeah. What about Roaring Kitty?
Yeah, unbelievable. I can't believe we come back to this.
I love it.
It's as bad as Bitcoin.
Yeah. So he's just, he had his first tweet, right, for a while. And then GameStop rallied. Was like 50% or something big? Or are you all the...
Was this you,
Vincent?
Vincent?
Around 70%.
Yeah. Were you long?
Perma long, of course. Always holding the bag.
I mean, this is close. I love this story because this is what it's linked to the way we think about markets, right? Financialization and the power of positioning. And that's why this market, this rallied. I know it's the whole I like the stock thing, but really it's the squeezing the hedge fund shorts. And that is empowerment to retail traders being able to do that. Understanding positioning. And now all the hedge funds have to know how retail guys are positioned. It's a new force in the market, a new flow in the market. And we want that for oil, right?
I read it as a 4 standard deviation event for hedge funds shorting markets.
Right.
So they've been, it's the other way around actually. Now it's the Roaring Kitty, the more the retail
have the power.
Yeah.
And that's leveling the playing field, right? So we want to see that in oil, and we will soon, but let's not talk about that right now. Googling oil, what are the key headlines?
Yes, so Googling oil this week, we've seen one based in nat gas in the LNG market. This kind of thing's been rumbling on for a while, looking at people commenting on whether the EU should call time on Russian LNG imports. There's been different countries have come forward and been like, yeah, we'd do that. But I think the reality of it is a lot more kind of complicated and does require a lot more thinking than just deciding yes or no based on a moral decision. We have seen now a remarkable success in slashing the reliance on the natural gas piped in from Russia. We've seen the US really step up in their amazing building of these LNG liquefaction and exporting terminals. But these projects for this year have actually been delayed quite a lot. And the ones for next year they haven't been able to kind of keep up with these deadlines that they've been setting themselves in terms of building these terminals and building these exports. So I think that is definitely something to keep in mind when deciding whether the EU can be kind of self-reliant in this way. Well, not self-reliant, but less reliant on Russia. In terms of the actual rule itself, the EU has targeted to end all Russian fossil fuel imports by 2027, but there's talk of this kind of bringing this forward to incentivize faster efforts to adapt. But I think it kind of incentivizes itself in terms of efforts to adapt, because the governments don't want to have the pressure of that kind of squeeze they saw the other year, because that was all being blamed on governments not being prepared enough, for example. And I think it's in every government's best incentive to be as self-reliant as possible. So I don't know what more motivation they can be given, to be honest. And looking to the north, Russia has found a huge oil and gas reserve in British Antarctic territory. This gets a little more foggy geopolitically, because the Antarctic has been protected since 1959 by the Antarctic Treaty, which prohibits all oil developments in the area and kind of keeps Antarctica as this kind of scientific space where they're not going to, cause any wars. But within that, it's also kind of separated. It's kind of like a pie diagram almost by country. The land isn't owned by Britain, but Britain has claim to the land. It's all a bit complicated, and something like this would really evolve a lot of geopolitical conversation.
Well, there's loads of things going on there. So Russia have found it in a territory that no one technically owns, but Britain have claim over it.
Yes.
I guess that's a very messy situation. That's going to be an interesting one to see. It is really messy. When you going back to the LNG, I think it's also kind of calling an end to, maybe not an end, but it's hard to see how disruption from Russian supply can, a lot of it has happened. The worst has happened. Even Russian refineries getting bombed, bomb taken off, sanctions, price caps. It's diminishing, right, in terms of the impact of restricting Russia. It's found its way back to being a staple part of the oil market in terms of analyzing its supply and demand. So at the end of the day, that's just another signal of it. If UK can wane off it, Europe can wane off it. It's kind of happening anyway. It's just it was the US maybe dancing around about their exports recently. But either way, I don't think huge things are going to happen structurally. So going back to the oil product market, again, if you can't rely on refinery outages from Russia, or basically export changes or sanctions impacting, we're kind of back to quotation marks normality. And I do wonder if something I was thinking about and talking about last week about diesel cracks, people are saying they're very weak. People have been stopped out on the long side, a lot of shorts, people making money from like kind of 38, 35 down to 20. But I think I mentioned before, for me, going back 12 years, my trading career, that 20 is a high level on a diesel crack historically. Like that is where we got to, not too much higher, even in the IMO situation where we were going to switch a lot of shipping fuel to kind of diesel related products and VLSFO. And there was a lot of speculation on that. I mean, 20 is a high level. So where did 40 come from? Well, 40 came from the Russia situation, outages, wars, hugely like big events. So it's just almost like the market got used to this, and the market consensus can be, people buy and sell on psychological levels in loads of different markets, and you don't really know why. Like you can have this debate about obviously Bitcoin and gold, like what is the actual utility, but you can say that about diesel. Why do we have to trade within this range? And for example, like high sulfur fuel oil, the common trade, you buy the cracks, so high sulfur fuel oil versus Brent crude, you have a delta hedge. In other words, when crude goes up, the high sulfur cracks tend to go down, and the correlation changes, but it's pretty high consistently. That's just something someone made up. I mean, there's no the physical isn't getting into the derivative market and going, right, buy Brent every time. It's the traders doing it out of consensus. And so these things can be very powerful, and people can it's just humans, right? They just love like believing in these normals and like liking these ranges without putting much thought to them. So if they suddenly break, like diesel cracks in a normal environment with no outages, Russia back to normal in terms of supply, refinery utilization back up, then why can't we go down to 10 or even 8 on diesel cracks? Because that historically is a low level for diesel, not 20. Do you see what I mean? So that's a bit of a ramble way to say, like, the more and more we talk, the more we're thinking like everyone's kind of pricing in a disaster scenario that's probably just doesn't exist anymore. And that's the risk, I guess, to all markets. But on refinery margins, Martha, what is the latest we can talk about?
The latest we can talk about is poor performance in Brent, overtaken by a really bad performance in the product. We've seen 85-cent barrel decrease in the week, driven by EBOB. We've seen a complete washout in the light ends in the past week or two. Rubbers down to about $21.50 a barrel in July now. It's kind of leveling out a little, like we're seeing in gas oil, which has driven up a bit more conversation about what's going to be driving it next. But looking at the CFTC, we saw the largest removal of money managed long positions since March 2020. So that's almost 20 million barrels were taken off in the week. And it was the fourth consecutive bearish week in the week to May the 7th. Gasoline demand in the States just isn't really giving like how we were expecting it to. We saw for the first week in May a 21.3 million barrel decrease compared to last year's same week, and demand was 7.5% lower than the average of the weeks between 2015 to 2019, which is saying something, because seeing the increase of gasoline being used year on year, it really begs the question as to why there is not this driving demand. And I think people point to EVs, or they point to working from home, but I think this is a pretty serious trend that we haven't really been seeing the rest of the year. So that's something to really keep an eye on. It'd be interesting to consider on this the impact of the holidays coming up. If Memorial Day weekend sees a good increase in gasoline demand, then bulls might have a bit more comfort to this kind of lack of demand narrative. But if we continue to see refinery utilization going up, stocks being built like fairly significantly more than they're expected to, which they have for the past 2 weeks, then we may continue to see this kind of being driven down lows. We've started to see, going back to the CTA positioning, our model of CTA positioning is just positive net position. If this were to drop into negative, then this may have an even further kind of snowball effect into kind of heavy selling in the gasoline market.
Okay, and trade idea for the week?
Trade idea this week, I'm thinking about going short in the Q3 380 East-West.
And then long.
Maybe next week. Maybe.
Go on.
Maybe next week. So currently going skewed towards the sell side. I think that's where the risk reward lies. So we want to be capturing its downtrend right now. So seeing the fuel oil, high sulfur fuel oil, fairly complex, seen great performance over the past month. As you see, Q3's risen from around zero, from flat to up to $9. So we kind of we're expecting mean reversion for a few reasons, because open interest has been stagnating. We're seeing trade houses taking profit at around the $9 per metric ton level. Previously, the East-West has rallied on the back of weakness in Europe, as well as market maker buying, plus strength from people buying 380 spreads. However, looking at the forward curve, current levels do look inflated, as well as we're seeing physical premiums beginning to fall. From our counterparty data, we're seeing most of the time the trade houses have been getting longer in over the month of April, second half, but recently has kind of stagnated as well. So we're thinking that the rally has reached a peak, with fundamentals waning, as well as 380 spreads coming off. It's seeing the spreads are seeing a peak of around $8 to $9 metric ton. I personally don't think there's too much upside to that. So considering these factors, I think that's why I'm suggesting a contrarian trade this week for the 380 East-West.
Nice, well reasoned. That's an interesting one. The only thing I've got to add, because I can't really say much to it other than it's Q3, so you've got a bit of time. So wide stop and all that as it's trending down, because there's a fair amount of time to go. But you've got to look at seasonality and where it's been historically, because again, this is the same point, right, that I was making with diesel. 380 East-West in my time has been 20 as a normal level. So it being like on a bull run and like 9 being the top, to me I know it's just so, it doesn't matter. These numbers mean nothing really in some respects, as long as you, if you're not accounting for freight and things like that. But don't forget that, right? Like seasonally, like it's not necessarily, if things are going to return to normal, and then China start picking up again with all this stimulus, they big buyers of shipping fuel, big buyers of high sulfur fuel oil. They run a lot of straight run in their teapot refineries. That could change a lot. And then historically, as Europe's outlet has always been the East. East-West is very important for that. So you're always expecting staple flow going there. So if you've got even more buying coming from the East and structural changes in the market, whilst maybe people are ramping up refinery runs here, refinery utilization is going up in the US, that puts the pressure on kind of Western high sulfur fuel oil and straight run. And then, on the flip side, at East-West. So just anecdotally, there's like fundamental threats to that, and the fact that we're actually on a low level historically. And if things are starting this year to go back to let's say 2020 levels, last decade normal levels, then that's not a very significant level to sell. It's not. You see what I mean?
Yeah.
That's the power of seasonality, is what I'm saying, or historical analysis.
Yeah, so I suppose potentially in the longer run, going into the summer months, it could potentially roll up stronger as well. So I suppose in the short term, we want to be having a tight stop loss in
well, not necessarily. I think you looked at it very objectively, and that's good, right? Then you're not biased. This is why young traders are really good sometimes, because it's like they don't believe, it's always does this. You're just not biased by that. But as you've done the homework, so it's fine. But a lot of people will say, it's too expensive, and it's recency bias. They're going, in the last years that's a high level, so I'm going to sell it. How is that? But you didn't mention that. You had very good reasoning for why it's overbought. But I'm just adding to it. I actually think it's a very good trade. So yeah. Okay. And our poll last week was about the SPR. What level will it reach by the end of the year? And most people thought 350 to 400 million barrels. No one really thought anything above that. And that's pretty significant because, there was talk about them refilling aggressively, and obviously they're not really in a position to do that. And if they do, that's a big stimulus for the market. But, having said that, the lower oil gets, and we're talking about CTAs and all that, two things: SPR rebuying and China buying. With their fixed price margins, a lower flat price does lead to more demand. SPR filling for both countries actually, but also just general ease of price and therefore potential demand increases. So we shouldn't disregard that to what we were saying earlier. But I think in general, we will leave it there unless anyone else has anything they want to say. Big ending crescendo? No. We appreciate you tuning in as normal, and there'll be more leadership podcasts coming up soon. Please keep an eye out for that, and of course Macro Mondays with James as well. Just to repeat that, please check it out if you haven't already. So thanks for listening, and see you again soon.